Hello friends, hope you're doing great. Welcome to our channel. This session is for education purpose, no investment recommendation, and it's your money, so please be careful. Yeah, in the previous session, we have covered introduction to stock market, basics of stock market, and stock market participants. Now, this session will only focus on stock market products and what are those all stock market products or financial securities which we deal with. And when I say stock market products, because they are uh, directly or indirectly listed on the stock markets and exchanges, you can deal with them there. So yeah, so let's start with that. So in equities we have stocks and preferred stocks. What is stock? So in the previous session also we have discussed that whenever a company want to raise money, they go to the public at large and then they try to uh, sell their shareholding in the company. What in stock, what is happening? You buying a shareholding in that company and you paying for them that particular shareholding. Now, common stock represents shares that represents ownership in the company. So actually you are buying ownership in the company. Usually you get the voting rights also. But are you involved into day-to-day activities of the company? No. A quick example of a share or a stock is HDFC Bank. Now, if you see this is you go to NSE site, you find any stock. I just open HDFC Bank, no recommendation. So HDFC Bank has this number that is its ISIN number. Then today's price is 964. Yesterday it was closed on 965 and then it's open today morning at 952. So you get all the details what and good thing is when you buy a stock, good thing about that is you can sell it in a day. You bought it today, maybe you sell it today, or maybe you sell it in a day or two. So you can, so the liquidity is also good when you buy a good large cap, medium cap shares. Okay. So that's an example of a share. Now we talk about a preference share, share that typically offer a fixed dividend. So in common stock, you do not have the notion of fixed dividend. Company will give you the dividend. Company will share the profit with you in the name of dividend whenever they feel comfortable with. But in case of preferred share, you have a fixed dividend, have a priority over common stock when the company goes to liquidation or company goes to the closure. Okay. Now, preferred stock also has one demerit to it that you don't get a voting right to it. So you don't have a voting right in the company when you buy a preference share. Now, you want to read more about preference share? I have added a link. You can go and you see what are the preference shares. Two type of equity. That is one is uh, common stock and another is preferred stock. Common stock give me the ownership in the company. Preferred stock give me partial ownership, but at the same time, my dividends are fixed. And if they are redeemable, means company can come and buy back those preferred share, then you don't get the ownership as such. Okay. And when company goes to liquidation, preferred share get liquidated first before get the priority also. Okay. Then comes your bonds. And bonds is basically a fixed debt or fixed financial instrument. What does that mean? That you buy a bond and you will get a fixed interest rate on top of it. Okay, maybe you bought a bond today and there are coupons you get every 3 months. That is an interest rate you get every 3 months in the form of a coupon. Or you buy a bond now at 980 rupees and then towards the end of 2 year you will get 1,000 rupees. So that is one time payment in the form of interest at the time of maturity. Now, bond may be a corporate bond. Maybe corporate bond is where issued by companies and company issued it because they want to raise a money. But they don't want to. Why they not going for stock then? Because they don't want to make you owner right now. What they thinking is that why not just we want some money for working capital. Company wants some money for other purposes. So instead of going and making you owner in the company, they say, no, 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 let's go with a corporate bond. We'll give you good interest rate on top of it, which is a fixed interest rate. And then they go ahead with that. Then government and treasury also issue the bonds. Okay. And why they do that? Because they want to do work in the areas of public projects operations, or maybe projects like hospital creation or dam creation or any of the road infrastructure creation. So they come up with, and even municipalities also come up with their bonds, and all the like Mahada can come with the bond, even BMC can come with the bond, and others. So let's see which all companies we do have. So I have added the links. You just click the link and you can. So you can see here list of corporate bonds. So corporate bond issued by NTPC, issue size is 140 crores, maturity is 6 November 23, so it's the older one, and coupon rate was 11.25. So this is important. So if you ask me, no, why should not I go for fixed deposit? In fixed deposit for 5 year, you get around 5 to 6%. In a bond, you get 11%. But please take a pause. Understand the risk is more in bonds as compared to FD. So you have to always consider your risk exposure versus the reward. Okay. Then you can see Poonawalla FinCorp Limited. They came up with 35 crore issue size and 10.40 interest rate, and that is valid or will expire on 7th of December 26. There is Kotak Mahindra, which is already expired in 23. There is Poonawalla FinCorp, other HDB Financial Services, 100 crore, 17 October 23. So these are your corporate bonds. But no, I want to understand more on a government bond or treasury bond. So I can bring those also. So you can see here which all government bond we have. So there is a Tamil Nadu Generation Distribution Corporation. Please understand this bond is issued by government of Tamil Nadu, but for the purpose of electricity and distribution. Coupon rate was 9.72. Yield was 13 point. What is the difference between them? We'll cover. But what is the important point, right? Here, the credit rating is also mentioned. Credit rating, I explained that when I was talking in my last session, when I was talking about all the credit rating firms, right? So here, I believe they should have also mentioned who rated it. Okay, so is there a rating? So they also mention a rating agency who rated this as AAA or A or BB. Okay, so you can see Indel Money Limited, that is triple B bond. Okay, so that's your corporate bonds. And then the last category in bond is that's a high level, right? There may be other hybrid bonds which we're not considering right now. I'm just walking you through the structure or the stock market products we have. Okay. Then comes in the last one, municipality bonds. Pune Municipal Corporation, issue in 2017, expire in 2027. So that is a 10-year bond. Amount they issue size was 200 crores. Coupon was 7.59%. That is your yearly coupon rate. And then tenure is 10 year, and ISIN number. ISIN is your international security number. With this ISIN number, even the international customers can also buy the security. Okay. Bhopal Municipal Corporation, again till 2028 tak, and then 175 crores. So if I now ask you, do you know the difference between equities and bond? The answer is yes, we should know. Stock is when I buy a financial security with an intent to get ownership in that company. And when I buy a bond, I just lend the money. I am a lender. I lend the money for 5 to 10 years or 15 years, and then I earn the good, reasonable interest on that. So that's the main difference. Bond intention is not to get ownership. Bond intention is to get or earn interest rate. I have money. I don't want to keep them in my bank. Rather, I'll go ahead with this one. Okay. So that's the main difference. Then we go to the next topic, that is our mutual funds. And this is again, right, a better option. So first three are very good option and earn good returns also. So mutual fund where you have, and that may be issued by any bank, maybe NBFC. And the only thing is mutual fund, we have a fund manager who manages our fund. So what you do, you buy a mutual fund few units based on the net asset value, that is NAV value. When market is going down, NAV will be down, so it's better time to buy. When market is going up, NAV will be high, so you can like be reasonable on buying, because what happened when you buy higher, then your wealth creation would be slower. So it's always a focus. Then when the markets are down, navs are down, then you enter with a reasonable amount that makes more money. So here we have three categories. One is where fund manager focuses investment into only into equities. That may be, and you must have heard like large cap mutual fund, medium cap, small cap, or multi cap. Okay, what is that? We'll discuss that in mutual fund sessions. But here our focus is that fund manager, when invest everything into stocks, that becomes a high level, at a very high level becomes an equity fund. When a fund manager put all the money into the bonds I explained earlier, that's your mutual fund, which is investing into bonds. And then the balance fund, where fund manager is focusing on investing into mix of stocks and bonds. Okay, now which all equity funds we have, let's have a quick look. So we have, and see this, right? So equity fund can be diversified on the basis of large cap, mid cap, small cap, large mid cap, that a mixture of large and mid. Then you have got multi cap, flexi cap. So you will get confused unless and until you know what you are aiming for. And that again is a topic of your personal finance, where we also consider that, boss, why should I go into a large cap? Why should I go into a multi cap? Why should I only focus on ELSS, right? So that is a very important question now. And that comes when you plan for your personal finance, when you plan for your wealth creation. And I tell you something, right? Why I get emotional when I talk about personal finance, but actually the name itself says personal finance. Personal because it's subjective to all needs. Maybe I have parents and grandparents, I have to look for them, and I am in my 40s. So my wealth creation plan and my investments would definitely be different from a person who is watching this video and in his 20s, where he or she has father parents earning well, and he does not or she does not have much of the money required right now. They can focus on a diverse variety of mutual funds also, because they don't have a immediate need. But person like me may have immediate need in 10 years. So then this is an equity funds. These are the equity. So you have ICICI. See, no recommendation, guys. It's only education purpose. So take it that way. And there are opportunities. We'll talk about recommendations as per compliance. So Motilal Oswal Mid Cap Fund, ICICI Prudential India Opportunity Fund. So all of them are equity funds. But you say, no, 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 no. Tell me more about bond fund, right? So let's see which all bond funds we have. So, if you are just focusing on investment, go to ET Money. This is a good site. Read about it. You will get good knowledge. So then bond fund we also call debt fund. And they also are of, so many bond funds. Fund to park money. That may be overnight, just one night. Liquid funds. They are very interesting, right? I genuinely feel liquid funds are better than FDs when you have a visibility that you want to move the money in some time. I give you one example. Like one of my friend's father got retired and he got good amount of money, and then he asked like where he should invest. So one way is you invest in FD, but then you block the money and you get some reasonable amount like 5 to 7%. And the other way is you put everything into stocks or mutual funds. But then again, if the market is at a high point, your purchasing power would be reduced. And if you are very lucky and market is at the lowest point and then you buy, but that never like generally never happens, right? So my all suggestion is always park your fund into these liquid funds, where you have a restriction for 6 to 7 days, and then after that you gradually do the STPs. That is your planned transition to the equities or to mutual funds, and you make sure you taking advantage of all the volatilities in the market. Not a recommendation, a perspective I am giving you to think about it education wise. And we'll talk about it once we reach to that point. Okay, then comes a balance fund, which is a mixture of your stocks and bonds. Okay, here again, right? And again, I'm ET Money fan, so I go there, and you see hybrid fund, aggressive hybrid, where maximum up to 75% investment in stocks. Then you have a balanced hybrid where you have 50% of stocks, 50% of. So what exactly in happening here, right? Agar, if I just see in a very simple format, you are asking your fund manager, see, I am a very balanced guy. I don't want to take a risk. I have earned the money and I am towards my retirement. You suggest me something which is very balanced and I don't lose money. I don't want to lose my uh, capital. At the same time, I want to earn more than the interest I earn on a FD. So he says, sir, why don't you consider balanced? Here, what we will do, we will invest 50% of your up to 50% of your money onto stocks and up to 50% onto bonds. So in bonds you will earn like average of 8% to 10%, a band maybe, and on equity side you may earn between 12 to 18%. So when we average out you will get 10 to 11%. And I'm like, boss, I'm very happy, let's go ahead with that. So this type of discussion has to happen when someone is doing your portfolio management, when someone is talking about your personal finance. But at this point in time, when I'm walking through these products, do you know the product? Do you at least know what are the products you have in the bucket? And then you can talk about on those. Okay. Now, with that, we move ahead. ETFs. What are ETFs? So ETF is basically again, a type of mutual fund, but they are exchange traded. They are passive in nature. These are exchange traded fund. ETF may be created on an underlying, that is your index, that is called index ETF. ETF made on index. So you have Nifty 50, Nifty 100, or ETF may be on a sectoral, that may be a metal or banks or private banks. Okay. And then you have a commodity ETF where underlying is gold, turmeric, or any other metal. Let's quickly see. And two sites, like if you really want to learn well, two sites. One is NSC site or BSc maybe, but I go to NSC as of now. Okay, so one is go to NSC, you will get all the details. So you can see market watch, ETF funds, and you get all the list of the ETF funds you have. Okay, that is based Nifty 50, that is based on your index, and it is mentioned Nifty 50, IDF, Nifty 80, right? Okay. Then I say, okay, can you tell me more on the sectoral ETFs? So we see what we have here. Again, I go to the same site and I say, show me the ETF on sector. So here you can see on the sector. So I believe I can select from here. Can you show me the gold? So it shows me gold. Can you show me Nifty 50 ETF? It shows me this. So you know that it's there, right? And then commodity, where the ETF formed on commodity like gold, turmeric. You have a metal also, Nifty Metal Total Return Index. Okay. With that, we move ahead. Guys, this is just an introduction talking about the each and every product, but we'll come and we'll discuss them in detail in our upcoming sessions. Now, the other one is derivatives. This is the most difficult area, options, futures, swaps. And this is a place where the risk is very high and rewards are high comparatively. So my suggestion to people always is, whenever you go to this area, you should have at least 5 to 6 good years of experience into other areas as well. So if you have a knowledge of other trading areas and you understand how to hedge my portfolio, understand how to trade in these entities, good to go. Go ahead. Okay. What is option? Option, let me take a simple analogy, right? There is a guy came to my home and said, I have a coupon for you, and this is a 50% discount on a pizza. And that is till today is 3rd October till 30th October. So whenever you go to Domino's or Pizza Hut, you will get 50% discount, but you have to show this particular coupon. I said, that's very nice. Give me. He said, sir, only thing is you have to give me 10 rupees for that. That is a charge for it. I said, why 10 rupees? No, no, I am providing you this service now that you will get 50% off. And I said, okay. So I paid him 10 rupees. That is a premium. That is a cost to that coupon. Okay. And I got a guarantee that I will get 50% discount on a pizza of my selection. One pizza only. Okay. That's written in contract. This contract is valid till 30th of October 2025. That's option. Let's not make it difficult. That's the option. Now, what is one thing I did not tell you? that you do not have any liability. You only have a right associated. Because you bought that coupon, it's your duty, it's your right within those within the time period of 30th of October. If you would like to go and buy the pizza, that is up to you. If you don't buy pizza till 30th October, this coupon will go zero and you will not get anything. So this 10 rupees is a kind of protection or insurance to have you a discounted price. That's option. If you understand this, we're doing it in and out. If you are engineering people, I know you go to Groupon site and buy all the coupons, right? All the discount coupon or dining, that's the option. That's the simplest way to understand it. There are many nitty gritties to it. We'll talk in option classes. But for now, it gives a right to the buyer, but not the obligation. There is no obligation that you purchased a pizza coupon that now you have to go. No, no, no. It's your right. You gave 10 rupees, you're good to go. If you think pizza is cheap there, quality is better, you go. If pizza is costly, you don't go. You go anywhere else. So I introduced two more terms. One is whether the cost of the pizza is better or not better, whether the cost is less or not. So as a buyer, whenever I execute my option, as a buyer, whenever I execute my option, I focus on two things. One is it is it cheaper than the market? If yes, then I'll execute. Otherwise, I'll not execute. The second part is the 10 rupees which I gave for the premium is basically a insurance or a protection amount. If I use it well, if I don't use it, it will get wasted. That's option is like a very vast, it will take few sessions, but I wanted to give you a simple analogy. So let's take that and we'll go ahead. Then comes your future contracts to buy sell an asset at a future date and price. What is the difference here? You don't get any right, you're not buying any coupon. What you saying, sorry, what you saying that okay, I make a contract with you that I will buy pizza by 30th October for 50 rupees, and we make a contract. If the price goes 100 rupees, you will be in profit because you're buying it at 50 rupees. If price goes 20 rupees, then you will be at a loss, but you have to buy because you made a contract. So future is a binding on both the parties. Okay, there is a difference between future and forward also. We'll discuss that when we go to derivative. For now, you need to understand that there is a derivative as a concept, contract to buy and sell an asset at future date and price. Please note, future has an obligation to fulfill the contract on both the parties, buyer and seller, whereas option has an obligation on seller to fulfill the contract, but buyer has no obligation. He only has a right. If he think I am in a profit, he will go and buy that pizza. If he think no, 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 it's not profitable anymore. No, 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 maybe I don't need it now. Then what happen? He just ignore and let that 10 rupees, that is a premium value, let him decide that let the premium value go waste. No problem. Okay, there is another concept swap, which is interest rate swaps, or that is very much used in the currency market and contracts to exchange cash flows or other financial instruments, swap. And it is also used in loan market also. Okay, so we'll take the example when we cover that. So swap is basically currency market, and for loan categories, there it is used extensively there. Okay, then comes a real estate instrument. Basically, what happens, like you cannot have a mortgage as a security financial instrument. So we have a real estate investment trust. So we make an REIT or an trust, equity REIT, own and operate income generated real estate, and mortgage REIT. So here we making a trust which is tradable on the exchanges, mortgage REITs. Okay, then the last one, certificate of deposits or CDs. It's like a your FD only. Basically, you are trying to earn interest on your money, on your capital. One is a fixed rate CDs, offer a fixed interest rate for a specified term, maybe 6 months, 1 year, 2 year. or maybe a variable rate CD offer an interest rate that can change over a period of time. That is basically on the basis of LIBOR, SOFR, or any RBI rates. And on that basis, a spread changes and then you get the variable CDs. So these are the products we have. And then we have commodities. Yes, it's very important, right? So commodities, physical commodities, tangible assets like gold, silver, turmeric. You will find that on stock exchanges, like I in my previous session, I mentioned NCDX or I mentioned MCX. So what they're doing, they are actually facilitating the trade for physical commodities like gold, silver, turmeric, oils, everything. Okay. And then Jira also. Okay. And then comes future on top of commodity. What does that mean? That means we are making a contract for future time period between buyer and seller for the underlying commodity. That may be a gold, that may be Jira, that may be turmeric. See, these concepts are difficult, but let me explain the commodity future at this point so you get an idea. So what happened? I am a gold jeweler, okay? And I understand that gold requirement increases during the Diwali period in India, okay? So, and I am right now, let's say in a February, March period. I understand the requirement of gold increases during the Diwali period or during last quarter of the year when there are so many marriages happen. But I am in February, March of the year, first quarter. So what I do, and I feel, that is the most important point. And I feel because the requirement will be high, because the demand will be high, there might be a case the price of the gold increases. So what I do, I go to the market, to stock exchange, and stock exchange, okay, that's future. I go to stock exchange, MCX, and I say that I want to buy gold in December, and today's price is 1,15,000. That's very unfortunate. It's so high. Today's price is 1,15,000 and I want to buy it at 1,20,000 because I feel that it will increase. Because I am buying at 120,000 for December or for October or for Diwali period, because it's OTM, out of the money, right? I am buying currently it's 1,15,000, but I am trying to buy at 1,20,000. So then I am a buyer of the contract. So I have to find a seller. On exchange, you will get the seller. Seller is a person who is ready to take that risk, but seller has a mindset that gold has already increased so much, it will fall down. So seller says, okay, I will sell you gold in October to December time frame, let's say October. That means I am selling you October future of gold at 1,20,000 per 10 gram. So that's a contract between the buyer and a seller. That's the commodity future. Now, if the price of the gold increases, the buyer wins. If the price of the gold decreases, the seller wins. Seller make profits. And both the people are bound by the contract, so they have to fulfill their commitment. That's most important thing in organized markets. In futures, forward has a different take. We will do that when we will do equity commodity derivatives. Okay, so that's pretty much on the product side. Just a quick view, a summary. We have equities where you go and buy the ownership in the company. We have bonds where you are lending your money to maybe the company, higher rate you charge as compared to FDs, you maybe to the government bond or maybe to the municipality bond. Generally, corporate bonds issued by companies are the range of 2 to 5 years, 6 years. But when government or municipality bond comes in, they are in the range of 10 years tenure. Okay. Then you have a mutual fund. Those fund managers, very smart ones, they actually invest your money either in equity or in bonds or in balanced funds. Okay. Then come the REIT, that is your real estate trust. And you have commodities, you have various ETFs and derivatives. Derivatives is very difficult. We'll discuss that in the right section. Okay. So with that, we wrap up and thanks for watching. Please do like, share and subscribe our video. And a request, please leave a comment with your what you really liked and what are the suggestions to improve. Thank you very much for watching.